But I would say that our expectation is that when you actually have rising inventories, that should result in more transactions. And what as I mentioned earlier, that and from a volume perspective, we've been at recessionary lows. So we're expecting existing home sales to rebound, but it will come at the expense of price. So while we're not forecasting national home prices to decline, we are expecting in the back half of 24 and into 24 and 25, or 25 and 26, that we'll see continued deceleration in home prices.
We'll be doing a housing market update today with two experts on the housing market, co-founder of Zelman Associates and Alan Ratner, managing director of Zelman Associates. We'll be going over their home price outlook, the outlook for mortgage rates, existing home sales, new home sales, home building activity, as well as the rental market, and generally speaking, just the affordability issue that a lot of Americans are facing today. So with that said, please subscribe to my upcoming newsletter. It's in the description down below. It's a once-a-week weekly recap of the previous week's news. It summarizes my own thoughts as well. Upcoming events to watch, news to watch, completely free. It's going to be launched the next week. So stay tuned for that and be one of the first to get the first issue. Welcome back to the show, Ivy, and good to have you, Alan. Welcome to the show.
Thank you, David. Thanks for having us.
Thanks.
Let's start with you, Ivy, first. We spoke last year, pretty much exactly a year ago, last summer. At the time, it was still unclear as to what the Federal Reserve is likely to do. People were talking about the possibility of another rate hike. Of course, we know that this year, the dynamics are a lot more different. So let's just start by talking about your outlook for what the Federal Reserve is likely to do this year and the biggest changes in the housing sector this year versus last year. I understand those are two separate questions. Maybe we can break that up.
Sure. I think overall, we are not predicting what the Fed is going to do with respect to cutting rates or not. I think that what we're focused more importantly on is what the long end of the curve going to do. And frankly, given the fact that the 10-year yield, which we think is generally reflecting the expectation the Fed is going to likely cut maybe once, if not twice, I think the 10-year is probably somewhat range bound within, call it 25 plus basis points to possibly head lower. But our view is that the 10-year yield, which is what mortgage rates are priced off of, is generally not going to be a significant beneficiary of rates cuts, because it's basically the yield curve is inverted. And what we're going to have is a de-inversion, and the long end is going to stay kind of where it is, and the short end hopefully is going to come down.
Ultimately, then how is the housing market going to react to any changes in the 10-year yield? We know that last year the 10-year yield has been more or less on an upward trajectory, and that possibly, ironically, depending on how you look at it, didn't actually crash the housing markets. Overall, the Case-Shiller Housing Price Index for the national average continued to go up last year. So how will it be the same this year, you think?
Well, first, just for the listeners, in terms of the transactions in 2023 were at recessionary lows in total. And it was pretty remarkable to see home prices inflating, 5-6% annualized when you compare the, divergence to what we saw in recessionary transaction levels. And that had a lot to do with the lock-in effect when free money was, flowing and people were locking in well below 5%. In fact, more than 80% of homeowners with a mortgage are locked in below 5 and more like 40% below 4. So you've got a lot of people that are disincentivized to move. And I think that you're right. The surprising result of even rates breaking up in 24 was early in the year, the continued resiliency that we saw. So despite the lack of affordability or stretched affordability, we saw home prices continuing to inflate. But really, the existing market remains at really very much depressed levels, whereas, and Alan can talk more about it, but the home building market has been a beneficiary of what has been very, very tight supply in existing market and has been surprisingly strong up until recently, when we're now seeing some weakness that has manifested itself, although that weakness is really, it's still okay, but it's definitely showing seasonally slower than normal for the past 4 out of 5 months.
Okay. So I'm looking at what...
Just one more question. I apologize.
Yeah,
I wanted to mention that you asked me, what would happen, assuming how would the industry react? How would the housing market react if the Fed cut and what the 10-year yield does? I think what we know is that the spread between the 10 and 30-year fixed mortgage rate is wider than normal. Historically, that spread would call it about an average of 175 basis points over the 10-year. And right now we're hovering around 260, so almost 100 basis points. So what we expect is that spread will compress when the curve de-inverts. And that has been historically a correlation that we should start to see and benefit from. So the housing market, if anything, you could shave almost 100 basis points off 30-year fixed rates, which would hopefully come to fruition. Although that's not a done deal, that's just the expectation that many mortgage-backed security investors are looking to see come to fruition.
Before we continue with the interview, I want to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. Alan, I'll let you shift gears over to you now, and we'll come back to Ivy later for some more macro updates. So I'm reading an article from Reuters dated July 1st. U.S. construction spending unexpectedly falls in May. So it fell in May as higher mortgage rates depress single-family home building, and recovery is likely to be muted by improving housing supply, the article reads. It also noted that the new housing inventory or supply is at a 16-year high, so basically the highest level since 2008. Can you comment on these dynamics?
Yeah, the new home market has generally been regarded as kind of the winner in all of this that's transpired over the last several years because of how tight resale inventory has been. And frankly, the builders have been able to buy down consumer mortgage rates to a more affordable level. So I think that actually gives you a little bit of a glimpse into what might happen in the market if rates were to actually fall closer to 6% or even back into the mid fives, which is where builders tell us they're seeing a lot of depth of demand. But what we've seen over the last several months as rates kind of unexpectedly reverted back higher again. I think to your original line of questioning, David, everybody came into this year expecting rates to be lower at this point in the year, and they're not because there were some inflationary concerns earlier in the year. And frankly, the economy has held up a lot stronger than most have expected. So when rates got back up above 7% during really what's the heart of the spring selling season, that's when the most homes get sold in that kind of March, April, May time period, it did cause demand to slow. And I think, to Ivy's point, it's not slowing drastically, but it's slower than what a lot of people in the industry had hoped and expected. So as a result, we are starting to see home builders dial back on new starts a little bit and kind of just take a little bit more of a wait and see approach rather than just build and put more inventory on the ground. They want to see whether rates are going to drift lower, whether they're going to settle out at these levels for the foreseeable future. And they want to see if demand ultimately rebounds from what has kind of been a somewhat disappointing end to the spring selling season.
Okay. Do you think that there are differences in terms of home builders' priorities when it comes to single unit, multifamily, condos, etc.?
Yeah, I mean, I could talk to the single family piece, and then I'll let Ivy opine on multifamily because that's a whole other beast, quite frankly. But on the single family side, I would tell you there's differences in strategies, even among the home builders, right? You've got home builders that are really prioritizing building spec product, meaning they're starting the homes without a buyer in place. They want to get these homes to a, completed status or close to completed because they're trying to compete with the resale market. They want to get that quick move-in buyer. And then you have other builders that are more build to order and, let the buyer choose their lot and pick their floor plan, et cetera. And what we're starting to see now, the spec builders are the ones that are most prioritizing volume. They want to take market share. They want to keep the machine running, and they're willing to do whatever they need to do to keep that machine running. Whereas the build to order builders might, try to balance a little bit between price and margin and volume. So I think you're going to continue to see a mix of strategies in the industry. You're probably going to see, in general, the public home builders trying to take share and force out some of the private builders that are struggling to get capital and source labor and land as well. But on the single family side, we think this is just going to continue to be a slow grind higher, kind of low, mid-single digit volume growth, fairly flattish pricing for the foreseeable future. And, that's the environment we're going to be in for a while.
Ivy, last year when we spoke, it was exactly a year ago. Have sentiments amongst current homeowners changed more or less? I'm reading news that new listings have come online. More new listings have come online this year. Are you starting to see more of a sentiment towards selling this year versus last?
Yes, well, which is reflective of listings rising year over year, now north of 20% nationally. I'd say that in certain markets, it's significantly higher. When you look at the markets where, frankly, new construction is very prevalent, whether it be in the Texas market, Florida markets, the Carolinas, we're seeing inventories significantly up, but still off of a low base. So comparatively to, let's say, the pre-COVID period, still in most cases well below. But you're seeing markets like Austin as a standout because it's actually pricing is down 2%, a little bit more than 2%. So there's definitely for builders that are operating in those, call it, markets that have been the most populous in terms of migration in and what during COVID and continuing as people have gone north to south or southwest, those builders are basically competing with the resale market. And now that the resale market is showing listings, there's going to be more incentives by the builders. There's going to be more people having to capitulate and reduce pricing if they want to move that inventory. So I think feels a little urgency than certain markets for people to take profits. A lot of people have made a tremendous amount of money in their homes, and maybe they're contemplating that this may not last. And so you're seeing them take their chips off the table. And I do think there's more of a seller's market that's evolving.
Well, let's comment on that. Why do you think it's more of a seller's market right now? Some reports corroborate with what you're saying. So, U.S. new home sales slumped. So this is Reuters article from the 26th of June. Sales of new U.S. single-family homes dropped to a 6-month low in May as a jump in mortgage rates weighed on demand. Um, you know, are people waiting for rates to come down before they start buying, Ivy?
Well, I think the affordability has gotten pretty tough. Not only have we seen home price inflation continue to make home buying more challenging, but also mortgage rates on top of that. And even aside, all the other costs like homeowners insurance and other non-discretionary parts of owning have all gone up, property taxes, utilities, everything. So it's just, obviously more expensive. So people are recognizing that maybe there's an opportunity to sell today and buy something that might be more affordable. For example, I was in Naples this winter, and there were people that were in a community where homes have actually tripled in appreciation, and they're selling and moving to further, call it sprawling out, where new construction is being offered at pricing that's much more attractive. But they're recognizing I better take some chips off the table, squirrel away some money because I don't know this housing market's going to sustain the level of appreciation that we've enjoyed. So maybe that anecdote is not applicable everywhere, but I do think people are getting nervous. I mean, you read the paper every day, everybody's talking about the risk of a recession. There's continued pressure with consumer wallets. They go to the grocery store and inflation's hitting them hard. So I think that people are getting more nervous, even if the confidence numbers are not reflecting that. I don't know, Alan, if you want to add anything.
Yeah, I would just jump in. And I think, perhaps something that doesn't get talked about enough, or maybe it is the fact that, affordability has been challenged, at least in the housing market for 2+ years. However, I would say it over the last 6 months is really where we've started to hear from home builders that they're seeing more stress among the consumer. They're seeing a harder time getting qualified for mortgages, less funds available for down payments, higher credit card debt balances. In fact, we do a monthly survey of private home builders that represent roughly 20% of the new home market. And a third of those builders said, compared to a year ago, they've seen a meaningful deterioration in the overall quality of their potential home buyers. So, in general, you've got fewer potentially buyers coming through the pipeline because a lot of people have already bought or moved over the last 3, 4, 5 years or refinanced at a very low rate. And on top of that, you have a somewhat slowing economy, putting a little bit more pressure and strain on the consumer and those that are looking to buy. So it's not surprising to see a little bit of a pullback right now.
On that note, Alan, the lumber price has been falling ever since the second or first quarter of this year. Is that a leading indicator for home building supply or activity?
Lumber costs have been very volatile. They doubled during the pandemic for a multitude of reasons. And I think, the pullback we've seen over the last year, to a large extent, a lot of that is just a normalization, I think, of some of the pandemic driven inflation that we saw. That being said, as I mentioned previously, we are starting to see a little bit of a pullback in housing start activity, at least on the single family side. Multifamily, we've been seeing that for quite a while now. But it stands to reason that that should, at a minimum, keep overall material costs somewhat at bay, as long as we don't see a reacceleration in starts.
Okay, so Ivy, your firm is projecting a stabilization of the 30-year rate at around 6.8% in 2024, going down rather to 6.45% by 2025, and then 6.15% by 2026, more or less mirroring your outlook on the 10-year yield, which we talked about earlier. Are you then assuming, and correct me if I'm wrong, but are you then assuming demand to pick up in later years because of this slightly falling or cooling mortgage rate?
Well, I think that we have to appreciate that those are, first of all, not our forecasts. That's really incorporating what's priced into the forward yield curve.
Okay.
We don't forecast mortgage rates, so that's obviously a broader view. But I would say that our expectation is that when you actually have rising inventories, that should result in more transactions. And what as I mentioned earlier, that and from a volume perspective, we've been at recessionary lows. So we're expecting existing home sales to rebound, but it will come at the expense of price. So while we're not forecasting national home prices to decline, we are expecting in the back half of 24 and into 24 and 25, or 25 and 26, that we'll see continued deceleration in home prices. And there may be markets that are going to see pressure down, actually negative pricing, given that, again, the other dynamics of the competitive market with new homes that they might have to compete against. So I think that the view is volume will come back, but at the expense of price.
And just to add to that, David, I mean, if you're looking at annualized home price appreciation in that low single digit range, 1-2%, let's call it, and you layer on top of that mortgage rates gradually declining, and you layer on top of that some modest continued income growth, that's kind of what's necessary to bridge the gap on affordability where we sit today versus getting back to long run averages. So as that gradually occurs, and hopefully by the end of 26, 27, assuming all of our forecasts come to fruition, the affordability picture would look a lot more normalized. That should be enough to support some volume growth, like Ivy mentioned.
For people who are interested in buying property as an investment, they're concerned about the cap rate. Can we comment on that? What's your outlook for the cap rate going forward, factoring in rent, factoring in mortgage rates, and just overall inflation?
Well, I think that cap rates have already expanded, depending on, which asset class you're looking and the magnitude of it. But I do think that specifically in the rental market and multifamily, there's still a lot of backlog that needs to be delivered. And therefore, we're expecting, and keep in mind, in multifamily, there's tremendous what we call wall of maturities coming. So many of the operators, developers that have financed at much lower costs are going to be having to refinance at much higher costs. So we think there might be opportunities and more distress in the market, not necessarily distress like working out to be a foreclosures spike, but what that likely would mean is that there's going to be more opportunities to buy at better value. So we think cap rates could actually expand further. We've already seen, again, that expansion. So I think that's reflective of the higher cost, that operators are now contending with, but we do think that cap rates can expand further.
Okay, I have this chart or visual I'll show for the audience. This is from Realtor.com, article dated June 25th, and it basically highlighted 11 markets in the U.S. In which home prices have fallen the most. So on the top of the list, Miami, then we have Denver, Seattle, Kansas, Oklahoma, San Jose, then Tampa, Austin, Detroit, San Antonio, and Raleigh. So I bring this up because obviously jurisdictions vary across the U.S., and so some markets have done well, some markets have not. Can you comment as to why those particular cities have perhaps seen the most in home declines? Is that, first of all, consistent with your research?
You rattled them off so quickly, David. I don't know that I can correlate what we found.
Let's just do the top three. So Miami, Denver, and Seattle.
I would say that our numbers would suggest that Austin would be at the top of the list for decline.
Yeah,
so
that's also on the list of top 10. Yeah.
I heard you, but I think that, when you just think about the markets that are seeing the most deceleration, I'm surprised to hear Detroit, frankly, because what we've seen is that the markets that have the most new construction are where there's more pressure. And that's just competitive landscape is greater. But like, for example, in my hometown of Cleveland, Ohio, inventories have barely budged off their lows. And so there's just not a lot of inventory. So demand is still outstripping supply, and we are seeing continued home price inflation. So where markets have a lot of inventory, not only rising and existing, but also have the new home to compete with, that's where I would expect prices to feel the most pinch. And so rattling off, you had a lot of Southeast markets in there. I heard quickly, and I think Southwest. So Detroit was a surprise, frankly. And I'd have to look that up and see what's going on.
Ellen, do you know if the new homes being constructed are being listed at roughly the same value as existing homes in the market already, or are they pushing up the index, do you think?
Yeah, so it's a really interesting dynamic because historically speaking, a new home has traded at roughly a 15% premium to existing homes on a per square foot basis. And what we've seen, it's a little bit tough to, firmly quantify because what the home builders are doing, which is very smart, is they're not necessarily outright cutting price, but they are offering the consumer incentives in the form of those mortgage rate buy downs, which I described earlier. And if you buy down the rate 100 basis points, if you go from a 7% rate to a 6% rate, from a consumer perspective, that's the equivalent of a 12% reduction in net home price from a monthly payment standpoint. So you're not necessarily seeing the outright price declines in the new home market, but on a net basis, and ultimately this is what impacts the home builder's gross margin, pricing is down in some cases double digits from the peak. And what that has done is it is kind of narrowed and in some cases completely eliminated that premium that a new home trades at versus a comparable existing home. And it's part of the reason why we've seen the share of new homes rise back up to long run averages closer to 15% of total home sales. A few years ago, that was closer to 10%.
Okay. I'd like to talk about the rental market now. As you know, the owner's equivalent rent, OER, is a significant component of CPI. So your outlook and ultimately where this market heads will be a big component or determinant of the overall CPI index. Let's just start by talking about your outlook on the rental market. Is it going to soften up or firm up, you think?
I think that the multifamily market, which is not as a significant part of the CPI, in fact, we estimate roughly 70% of the survey is really single family rental. And so when you look at, including OER, when you look at multifamily, while multifamily has normalized, we think there's still potential further pressure. Not a lot, but we've seen normalization and we expect kind of 2% rent growth in 24 and a little bit higher in 25. I think that that's really a function of a lot of that supply that still needs to be delivered. I think in the single family rental market, we're seeing deceleration, a little bit higher rents in the 3-4% range. So I think when you're thinking about what's happening in CPI, we're still over 5% when you're looking at year over year growth from CPI. So there's a lag effect. And I think it's a little stickier because when they're surveying households, which is what they're doing for OER, many of those households might not be turning, and therefore their rents really haven't changed much. So it's stickier. And I think therefore maybe it's not the right measure to really understand and gauge what's happening with inflation. But with respect to what we're seeing in the market is that the multifamily market, which has normalized and stabilized, we think there's a little bit further pressure coming, but in the very near term, it's stabilized, but we think further coming. And in single family rental with more competition in the market from build for rent and just more listings, we expect there'll be some further deceleration, but again, not much.
During the pandemic and immediately after, what we saw was a lot of people moving out of big metropolises like San Francisco, New York, etc., into smaller towns, the Midwest, and we saw actually a rise in rent in some of these smaller cities. Is that still the trend now?
I think rents have continued to inflate. Yes, I think not, albeit at anywhere near the levels that they were accelerating at during the pandemic, but renting has become pretty expensive too. When you're looking at rents as a percent of income, we're back to what would be pretty much higher than historic averages. With that said, I think when you compare renting versus owning, and we did an analysis for what we would say is an apples to apples analysis, where you're looking at a community within a 2-mile driving distance from one another, same school district, same square footage, you were literally 9% better off renting a single family brand new home, what they call built for rent, versus owning that home. And that's the analysis I think that's the most applicable as compared to just if you frankly just said, what's multifamily rent compared to buying today, that would be almost a 30% better off equation. But that's apples and oranges because someone who is in a multifamily two-bedroom apartment but needs to move because they're having their first child, it doesn't really matter if it's 30% more affordable to be in a rental with two bedrooms. I need a bigger home. I'm likely to go to a single family rental and still get an advantage. But I think that's the better analysis.
What I'm wondering is whether or not existing landlords are likely going to change the rent because perhaps their rates are up for renewal, and so maybe they financed a much lower rate, and now the 30 years is much higher than it was, 5 or 8 years ago, whatever it is that they initially financed. Is that going to be the case, you think?
Well, I think what you're saying is they choose occupancy over price. They want retention, and therefore they're more likely to negotiate and not push that much on renewals. And I think that's really a function of what's going on. I mean, this normalization has been new move-in rent had actually gone negative, and we've seen deceleration in renewals. So that's happening. And I think occupancy has been, what the operators are choosing to focus on, and therefore you're right, they're going to try to retain the tenant rather than risking losing them.
So, Alan, where I live, which is Canada, Vancouver in particular, there are these new zoning proposals whereby people are now incentivized or encouraged to build multifamily units in single family lots going forward. This is obviously to incentivize home builders to solve this housing supply crisis that Canada's facing. I'm not sure if the same is going on in the States.
There are certain cities that have attempted to do similar things. A lot of them out in California, for example.
Yeah.
That's not a business that the large public home builders typically get involved with because, frankly, it's pretty inefficient. It's not a production type model. It's very one off, and it's hard to scale in a meaningful way. So we definitely hear examples of that on a localized basis in certain cities, but we haven't seen it taking off in any mass quantity, and I don't think it's really on the radar, frankly, of the largest builders in the country.
Do you think builders are looking at long-term fertility rates and home household formation stats to make decisions? Household formation has been relatively consistent over the last year and a half. However, the projection for fertility rates in the U.S. and actually in most OECD developed countries is down. I wonder if that's going to make an impact on what's going to be built in the future.
Ivy, you want to take that one?
I was going to say, I don't think the builders are focused on fertility rates, frankly. I think that they're optimistic that household growth will continue running at what had been historically, call it all in, that you're going to need to have 1.35 million households and add on top of that whatever is obsolete slash demolished to replace it. So they're pretty comfortable with demand being called 1.5 million units and using that sort of big picture. But they're very micro market focused. They're down at the zip code and looking at, where we should open our next community, what market is most attractive. I don't think necessarily they're really focused on any macro data, including fertility rates.
Overall, then, can we expect just going out in the future, more of a priority for condos and smaller apartments versus houses?
Well, I think one of the things we talked about in a recent piece we did on updating our household outlook is that we think that the multifamily, units will be disproportionately beneficiaries from increasing households because of the Generation Z. But we know that today, if you're looking at what's driving some of the increase in our household growth forecast, it's also immigrants coming into the country. And typically those immigrants are not going to have initially the ability to rent a home and or buy a home, right, with their lack of documentation. But eventually their headship rates will increase, and it's likely they probably start more likely in multifamily. So I think, we need more lower square footage, more affordable housing, whether it be rental and or purchase. And on one hand, that's, the obvious, I think, but the demographics suggest that also is going to be the outsized beneficiary.
Housing affordability has not been this bad since many, many years. I'll let whoever want to take this next question comment. What needs to be done to, I guess, make housing more affordable for millennials and the younger generations?
Well, I think that you have three levers, right? Mortgage rates, price, and income. And those are the three levers that will, drive affordability. And so Alan alluded to it earlier. If wage growth remains, 4-5% in that range, and home prices are flattish, and mortgage rates come down, that will help, solve some of the affordability problem. I think that is really the only way we can look at it simplistically. And there's obviously potential changes as it relates to what, legislators can do. But really, I don't really see anything beyond that. I don't know, Alan, if you want to add
Yeah,
anything.
the only other thing in the new home arena, and remember, I mean, the new home market is such a small piece of the overall pie that it's really hard to move the needle in a short period of time. But over time, it adds up. We have seen a pretty consistent downtrend in the overall square footage of new single family homes that are being built in this country. In fact, last year, the average square footage of single family starts fell 3%, which was the largest year on year decline we've seen in decades. So, and this is coming, through a number of different ways. We're seeing a lot more attached townhome product being built. And this is almost being done out of necessity because all of the cost inputs that go into building a house continue to go up, right? Land gets more expensive every day. We've talked about lumber. Yes, that's come off of the highs, but is still kind of settled into a more normalized level here. So, in the absence of any material cost declines, which, by the way, a lot of home builders, if you would have asked them 2 years ago when rates first started to go up, they all would have told you that they would have expected their build costs to be significantly lower today than they are. And we just didn't really see that unfold. We saw, kind of costs hold in relatively steady. But in the absence of cost relief, you have to either shrink the size of the home or find other levers to pull in order to, improve that affordability equation. So it's those three levers that Ivy described, plus probably a continuation in the downtrend in terms of square footage of homes being built today.
Okay,
Now,
this is a sorry, please.
I'm sorry, I was going to ask Alan to maybe elaborate too on some of the challenges that the builders are facing with new regulation related to energy codes that
Yeah,
really.
it's a great point because that's another hidden cost that's very prevalent in this industry that doesn't really get talked a lot about. You've got energy code requirements that are changing, by the year and becoming more stringent for home builders to abide by. You've got local municipalities that are applying impact fees and other fees along the development process to pay for local services and whatnot, and those continue to inflate at a very significant rate, and that all gets kind of embedded within either the construction cost or the land cost that a builder has to absorb. So it's part of the reason why we just don't see an easy path towards building a lot of affordable product in this country, which kind of does put more of an onus on rates and income growth, and if not, then you probably just settle out in this slow grind like we talked about earlier.
Well, I'm just wondering what options are available for first-time buyers and what they're doing. This is a stat from dated May 1st this year. First-time home buyers are continuing to have trouble affording a home, says this article. They now need $120,000 household income to be able to afford the median-priced home. And in America, 44 out of the 50 largest metro areas do not have home prices that are low enough to be considered affordable, right? According to the Census Bureau, the average household income is $75,000 in 2022. That's a huge disparity between what households are making and what is supposedly needed to buy a starter home. Can you comment on this?
First, I'd say that many are dual household incomes. So right away, if you take two incomes at 75,000, you're going to be able to afford that $120,000. So I think that, we see what had been up until recently, as Alan said, a pretty good first-time buyer market. And, we talked today, we had an opportunity to chat with Toll Brothers management team, and we're talking about they start selling in the 300,000 price point across most of the US, and they consider it first time affordable. I think that surprisingly, there's just a lot of wealth transfer also helping young people out today. I think that, there are significant down payment contributions from family members and outright purchases by family members, with boomers and Xers wealth being transferred. So I think that's helping those that have that wealth. But overall, I'd say dual incomes help to offset some of the affordability challenges of that 75,000 household income data that you're providing.
Well, given these current dynamics, for current homeowners, who do you think will have the easiest time moving units? Owners of single family, multifamily, or condos?
Who will have the easiest time moving
Selling,
units?
selling their existing homes.
First time buyers for sure. So one thing we didn't talk about, David, is the robust still investor prevalence in single family, and whether mom and pop investors. Institutional investors account for less than, a few percent of the overall market. So it's still highly fragmented, and many individuals own many homes in their portfolios. And what we find is that when there is a, let's say, home that's in that 300,000, or even in some submarkets less than that, they are on the market with, sold within days, if not the day it gets listed. And the challenge is that in some cases, because there's such a strong investor bid, many of the buyers are having difficulty competing with them. In fact, there's a legislative bill that's floating around out there trying to provide investors a reason to sell their entry-level homes that they might be renting out by offering them a reduction or elimination of a capital gain tax, in hopes only if they sold that home to a first-time buyer, because it's that competitive. So I would say, if you own entry-level homes, I would say if you sell them, you'll be by far the best in terms of returns right now.
I've heard the theory from some people I've talked to that given how expensive homes are relative to incomes versus what they were, in the past, that younger people are less likely to start a family and perhaps delay marriage and household formation. Do you have any evidence to back that up?
Well, we actually were expecting, that trend to continue, but starting in 2020 and really through 22, which is only the data that we have available, we saw a big spike in young adults leaving mom and dad and starting a household. And we've seen a pickup in birth rates during COVID, which maybe people had nothing to do, but have some, time to think about having a family. I think that we're not expecting, though, that trend is going to continue. We do think there's a lot of pressure. I can tell you that my children that are young adults, my almost 24-year-old is like, I don't even, know, mom, that I'll ever start a family because it's so expensive. And you do hear young adults, pining on the challenges in this economy, whether it be, having their own place or starting a family. So I think, unfortunately, that trend is likely to continue with respect to fertility rates remaining depressed, and also the likelihood that maybe they delay marriage entirely. I know, Alan, if you want to get on your soapbox at all, but he's got little kids, so he doesn't know yet.
Yeah, no, I would just say, the data has frankly surprised us that it hasn't unfolded that way. We have seen young adults moving out from mom and dad, and frankly, we expected that to occur before the pandemic, and it didn't. And the last thing we would have expected is that it would be occurring now, given kind of what's going on with affordability challenges. But I think that's just a testament to, frankly, how strong the economy's been and how strong income growth has been. So we've had a really strong consumer. We've had a really strong backdrop of stimulus that's been pumped into the economy, and I think that's allowed a lot of those things to unlock. The real question is, how sustainable is that in the back half of the decade if we do get a little bit of a slowing in the job market? And we know that savings rates have reverted back to levels, that they were at 15, 20 years ago. So all of that excess is long gone at this point.
And Alan
Okay.
did an interesting correlation to showing the change in savings rate and the impact it has on overall home sales. So we have seen, maybe now with the depletion of savings below historic trend line, we are seeing a slowing in home sales. And that really is, the reflection of the point being is that maybe a lot of those savings that were inflated helped to keep the housing market at much higher levels than where otherwise could be sustained.
Is there a relationship that you've observed between home prices and values versus consumer spending? There's been some academic research done in the past showing that the wealth effect contributes to spending. If your home is more expensive on paper, you're richer, therefore you spend more, even though your actual cash flow may not have changed. Is that true?
I don't know that I can point to any research we've done in terms of correlation. I know off the top of my head that consumer spending is about 70% correlated to housing starts. So I don't have data to suggest that home prices, when we look at remodeling and spending on your home to improve it, the most important correlation is to home price. So for example, that correlation is over 90% when we see, what is the best indicator for future remodel, it's where home prices are. And directionally, remodeling has been now starting to see, a tougher time as it's normalized. But I do think that would bode well to your point that if remodeling is a reflection of consumer spending, then home prices are the most important variable.
Do you have anything to add to that, Alan?
No, I was just going to say, we have seen that correlation on repair and remodel. So I would imagine that would be a pretty good microcosm of overall consumer spending, but we haven't looked at it on that large of a scale.
Do you expect agency fees to change in the coming years, or perhaps even more immediately with the rise of some more direct uh, avenues to basically bridge buyer and seller? Some people are foregoing agents altogether.
Well, if you're referring the idea of the NAR settlement and what the impact will be on the market, I think that what our expectation is that you'll see pop maybe modest pressure on commission rates, but I think the industry is adjusting and it's about disclosure and recognizing that many first-time buyers that will want to have representation. I think the question is there a back way of helping them and not having the seller pay that commission? And there's other things that are becoming maybe creative backdoor ways of still getting them what they need, which is representation. So we're not convinced that this is, draconian to the industry. If anything, I think there will be modest, if anything, pressure on commission rates, not much.
And we talked about the cities that have dropped in price. Do you have any research on jurisdictions or types of cities that you think will have the most potential for price appreciation over the next 1 to 2 years?
We don't forecast pricing by metro market, but I think directionally, I, personally feel that markets where, again, there's not as much new home competition. I think the Midwest, for example, when you look at markets that are benefiting from very strong job growth, an area like Columbus, Ohio, where they're building a chip plant with worth $20 billion, and there's a lot of incoming jobs that will be a result of that. I think that also, I think I mentioned this last year, David, but I'll get on my soapbox again a little bit. I think climate change is going to have an impact on the markets that are suffering right now with excessive heat and flooding, and people are going to migrate back to the central part of the country, and it might not happen immediately. But I do think over time, the other thing you didn't mention, I thought initially you were talking about agencies. I thought you meant Fannie and Freddie, because I think that the regulators are going to have to start pricing mortgages that are more prone to climate risk with higher loan level pricing adjustments at some point. And I think that those are things that are on the likely to come over a longer period. But I do think that that's going to impact where people want to live. I mean, I just had a friend text me, say he's in Phoenix, it's 117 degrees. I mean, are people going to just, and it's only July. I mean, how many people are going to want to continue to live in those excessive heat markets? Maybe they will, maybe they won't. But I hear more anecdotes of people contemplating maybe leaving the areas that are easily flooded and or excessive heat and fires, etc.
Well, that, and I think you brought up to me last year, home insurance costs would go up as a result, right? Can you
Yes,
comment on that?
yeah, they have skyrocketed and they continue to be under severe upward pressure because the insurers are getting hit the hardest with the losses. I mean, if anybody's seeing the impact from climate change, it's the insurance industry that can't continue to the magnitude is just overwhelming. So many of them are exiting markets, whether it be in California or Florida. And as a result of them, many people are determining that maybe they do self-insurance, which is not great. If people are betting that they don't need insurance, which is what self-insurance is, I think that is a very risky strategy.
Well, hold on. Since we're on the topic of climate change, one of the risks of climate change that's speculated by scientists is rising sea levels. Are we expecting people to migrate out of coastal cities then?
Well, that's what I'm saying. I mean, whether it's flooding, whether it's fires, whether it's heat, my view, and I am probably the Lone Ranger right now. If you ask builders, they wouldn't agree with me. But I think eventually consumers, and it might be that it has to have some, sea changing event, maybe a sea surge that wipes out, communities that they decide, I don't need this anymore. I'm leaving. But I think that's bound to happen if the scientists are right. And we haven't really seen that. But there's been some people that have left. For example, I have a home in Naples and they've decided to sell that are on the coastal part of Naples and they just don't want to be there anymore because the risk of flooding and the impact of homeowners insurance and others. So anecdotes, but directionally, that's my view. And it's not really based on science. It's based on the scientists and what I read, but not any inherent research.
Alan, are the home builders reacting to this at all?
Yeah, the builder's response to this will be, number one, if you take a place like Florida or the Carolinas, they're not really building on the coast, right? There's no developable land there. So they would actually make the opposite argument. They would say where our communities are actually more inland and, potentially could benefit from what you just described. Number two, they would also argue that the insurance costs of a new home are significantly below resale because they are up to code, the latest codes with hurricane resistance and fire and things like that. Energy efficiency is a huge thing, especially in a lot of the hot climates where they've got the proper insulation and potentially, other features in the home that result in much lower electric costs. So the builders would make the argument that they're actually in a competitive advantage if what you described materializes in any meaningful way. But I do think it ultimately goes back to the pocketbook and the wallet for the consumer. If the insurance costs in certain markets continue to skyrocket and make it even less affordable to live in a place like a Florida or California or places like that, then I think you will see people ultimately move into places where they can afford and perhaps where some of those costs are not as excessive.
Finally, I'd like to touch on the risks of a financial crisis. This is a tail end risk, but I'd like to address it nonetheless. Some people have brought up to me the possibility of 2008 reoccurring. So the concern here is that as personal savings dwindle, as costs continue to weigh down on consumers, consumer spending is going down. As you know, delinquencies on credit cards going up. People may eventually start defaulting on mortgages. Foreclosures may go up. We don't know how exposed the banks are versus now versus 2008. Can you comment on this risk, whether or not this is even significant?
Well, I think that the guardrails were put in place in the housing market by the legislation by Dodd-Frank, and that by having the qualified mortgage regulation, we have had good guardrails, and therefore there's a lot more equity that people have put into their homes when they purchase them, and we don't have liar loans and crazy mortgages that offset the lack of affordability. So, FHA, which is what, Alan, not even 20% of the market today, where people are only putting 3% down. Certainly, there are some VA loans, 100% LTV. There's no question there could be, foreclosures if we have a severe recession. But overall, I think that there's significant equity in home ownership today. And I think that the risk would be more likely specific to areas where jobs were, where people lost their jobs in a significant way, rather than the mortgage market and banks, their exposure to, overall residential mortgages. A lot of them are not as exposed as they had been. I think that you have the GSEs and mortgage-backed securities through Fannie, Ginnie, and Freddie that are in the market. They just risk off and are selling that to investors and to secondary market. But I'm not in the camp that we're going to have another GFC. But I also don't know what's going to happen. I'm more concerned about, if we have something that's, substantial changes in what might be climate change and with the impact that it can have in markets and the costs associated with ownership, to Alan's point earlier. So those are things that, you can't predict, but we're watching. And, I think that there are going to be changes that we have to be on alert for. But right now we feel better than we did going into GFC.
Okay, Alan, I'll end with you. So same question. Anything to add to what Ivy said in terms of macro risks that may damage the housing markets?
No, I mean, from a home builder perspective, the industry is in much better shape today than it was in 2005. Much less leverage being used. In fact, if you look at the public home builders today that are over half of the new home market, back in 04, 05, they were about a third. These are companies with virtually no debt on their balance sheets, huge cash positions. They've minimized their risk of large land assets, and focusing much more on assets that can turn more quickly in a potential downturn. So we just don't see as much of that risk factor from a new construction standpoint, at least on the single family side. And as Ivy mentioned, I think that the mortgage guidelines that exist today is a huge differentiator today versus back then. If we end up in a recession though, and there's job losses and there's foreclosures, there will be pain. We don't want to minimize that, but I also don't think that we're looking at nearly a collapse like we saw back then.
And what we said, David, just to what we've told our clients and what we continue to address is that when we think about this cycle, if we did have a recession, it would look more like the 1990-91 recession or the 81-82 recession, very similar in terms of volume declines and while pricing didn't go down nationally, you definitely have markets that experience price pressure. So that's really what we think would be more likely to come to fruition, and therefore not a GFC, but a recession. You would see, down volumes and overall price deceleration pretty significant.
Just one final note, actually. Now I think about it. The flip side, is it possible that you'll see a surge of demand from foreign buyers? Was that factored into your analysis as a possibility?
Not really. I think that, depending upon, what's happening with the strength of the dollar and where currencies are, a lot of that will influence but foreign buyer demand. But, one of the questions we ask on our realtor survey every month is, are you seeing a change in foreign buyer appetite? And right now, we really haven't seen a resurgence in foreign buyers that were prevalent really back in 2014 through 2018, 19. It was very significant. And I think that's now probably back to the lower levels.
Okay, well, very good. Thank you both. Ivy, where can we learn more about your work?
Just reach out to us on our website, zelmanassociates.com, or call or email, Kim, at Zelman Associates. I also appreciate the opportunity, David. We're hosting our housing summit in Boston. We're back in person this year, September 12th and 13th. So if anyone's interested in joining us, we have a pretty significant lineup across our entire ecosystem of all the silos in the housing market. So we're excited to return in person. So if, again, you're interested, reach out to Kim at zelmanassociates.com. And otherwise, we really appreciate being on your program. Congratulations to all your success, David.
Thank you. Well, I appreciate you being here. So thanks to great analysts like you that we have a good program. So thank you for coming back. Yeah, we'll put the links down below if you want to follow Zelman Associates. Make sure to check out those links in the description. Thank you very much, both of you.
Thank you.
Thank you, David.
Thank you for watching. Don't forget to like and subscribe.